Welcome. How's everybody doing? Hope you are doing well. My name is Andrew Kuhn, Focus Compounding. Thank you so much for tuning in with Geoff and myself here today. Geoff, how's it going today?
It's going very well, Andrew. How's it going with you?
It's going great. We hope it's going great for everybody else. If you're watching on YouTube, hit that subscribe button, thumbs this video up. If you're listening on the podcast side of things, hit that subscribe button. Unfortunately, you can't thumbs it up, but you can leave a rating and review. And if you do that, we would be very thankful for that. So in today's podcast, we are going to be talking about something that we get asked all the time. And that is, how do you tell the difference between a real business and a fraud?
Yeah.
Sometimes investing in the space that we invest in, rightfully so, this is a great question, there could be frauds.
Sure.
More so probably, I would say, in the micro and small cap space than in, a large cap space. And I think a lot of investors are very scared, rightfully so, that they're going to invest in a business that happens to be a fraud.
Yes, and I think many investors might. So that's a good reason for being scared.
What do you mean by that?
The things that they're looking for could easily get them involved with a fraud.
Okay, like what? We're just going to roll into it. Like what?
Big promising area of technology and stuff, that it's going to grow to the moon, that it is a new and different way of doing something in that area, that they've built a better mousetrap that way, that they have a charismatic leader running them, that they have all of those sorts of things. Yeah, those kinds of things that appeal to people.
Sending rockets to the moon? No, I'm just kidding. Just kidding. It's a joke. It's a joke.
Yeah, but cannabis, solar.
Cannabis, yeah.
China, countries that seem promising in different ways, technologies that seem promising in different ways, especially things that might be like consumer things or something in some way so consumers understand what they are, and then they don't understand what the company's doing.
What do you quickly do, though, to sort of like decipher if a company is a fraud or a real business? What channel checks?
One of the first things I do is look at what state are they incorporated in, why, stuff like that. And this is part of the thing that we're talking about, a warning. I have warned people before, and I warn them again, to be careful about companies incorporated in the state of Nevada. We have have relationships with the company incorporated in the state of Nevada. We're nothing that we actually own anything in is incorporated there. But, we've also, Focus Compounding is incorporated in Delaware.
Oh, that's what you're saying. Got it.
We're thinking of two different stocks. You're thinking of a stock that we own. I'm saying that we also have a relationship with a 10% owner of our company that is in Nevada as well.
Got it.
So we have multiple things in which we own 10% or more of a company, or a company owns 10% or more of us, or whatever, that incorporate in Nevada. So why is that? And why aren't we worried about that or whatever? I would caution people about that because there's often a reason why a company has changed its state of incorporation to Nevada, to Delaware, or from the state it's originally in. The best case, in my experience, has been a company that doesn't change its state of incorporation even when it would benefit from it. And I've seen companies like that where, because they didn't change their state of incorporation, they are more susceptible to getting one person on the board or something that they wouldn't like, or having a court case that being decided in a state that they don't want it in. So for some reason, some company has taken a decision to move its state of incorporation and has chosen it to save money on stuff, to make things easier, to be in court where things maybe there's more experience, more ability to understand what will happen and stuff. Delaware is a really good example of that. And then there's other ones where I think people may be better protected in case of fraud. I've said Nevada is a state where people I think will be better protected in case of fraud, in the sense
if they're running a fraud.
If they're running a fraud, in the sense that they personally may be better protected than the company, that certain acts the company takes are less likely to be attributed to them personally for criminal prosecution and stuff like that, I think. That's what I would say. I would say that's a reason why you might be in Nevada. There are other reasons. And I think sometimes early on, there were legitimate reasons why companies chose that state. New Jersey had companies incorporating it because it had certain favorable laws, and they were across the river in New York. I know that some companies went to Nevada because it was somewhat favorable versus California initially, and there were lots of companies in California. But if you have random companies around suddenly changing their state of incorporation, it's something to think about. Auditors, if they change their auditor, why did they pick the auditor they do and stuff? We've bought some into some companies in which I think the auditor is not very good and the audit isn't very good, and I've said that. So why would we do that? I've cautioned people to be careful about auditors by pulling their PCAOB report, inspection report, and reading about what it found, that they did well or not well. But there are good reasons why a company might use a poor auditor, because they need an auditor who's willing to submit to a PCAOB inspection report and stuff, an auditor that's willing to audit public companies, public issuers, and yet is really cheap. And there aren't a lot of them. So you will sometimes see the same auditor show up for those sorts of things. So those are the things I would caution people about. And yet I'm saying at the same time, we have bought into situations where I would say the auditing isn't necessarily that good. Also, not a surprise, we've owned stock in companies, which are public companies, meaningful businesses, in which what the auditor is being paid is less than we've sometimes been quoted for what they would like to do for auditing hedge fund related things and stuff, which is a very small scale thing. We are not very active in all sorts of stuff. That gives you an idea of how little people are paying for some audits. We own companies in which the audit fee is about almost 100 times. I'd say we have a company where they pay about 65 times more for the audit than another company. So that gives you an idea of the range that you could have to pay an auditor. There's a reason why companies don't want to pay $1 million for audits, and why some companies do pay large amounts of money for audits. So I would be cautious about the auditor situation. I would be cautious about the state of incorporation thing. The important thing is to know, why did they do what they did?
Yes.
A key thing for us in terms, if you look into it with the Nevada thing, to be honest, is we've been involved with some companies in some way with the Nevada thing, whatever. If you really dissected their history, you would see that their being in Nevada may be attributable to a party that no longer
in the past
is involved with the company. I don't want to get into all those things and stuff, but if you really look into a company, the fact that someone we may not have loved once was involved and had control over some things at a company that many years later they have nothing to do with the company, that really doesn't affect our attitudes about that company. Now, if last year they switched to an incorporation in Nevada with the CEO they have now, and they made that change because of, and we see no good reasons for why they would do that, then that would be concerning. And, we will invest in companies at times where things we didn't like happened with a previous management team. And if you look into investigate those things, you may find that we have invested at times in companies that 10 years ago or whatever were run by other people, but we weren't buying them 10 years ago. We're buying them today. So the fact that they're incorporated someplace is kind of like the fact that that old CEO may have paid himself $1 million a year and this one doesn't. We're not, we're invested with the situation now going forward.
Yes.
So sometimes that's true. And in fact, to be honest, sometimes we've invested in companies in which I think there was some bad behavior at some time in the past, I would guess. But we won't talk about that and stuff anyway. And I would prefer the companies themselves don't get too embroiled in that. I would, rather them not litigating the past and stuff, but moving on and improving the business today.
What are some other things that you like key check? So we have the state of incorporation, we have the auditor. Is there other stuff? So I guess back when people would reach out to you about investing in Chinese reverse mergers, what were some tips to you where you're like, no, this company's a fraud? You're not even.
To be honest, I felt that.
Or is it more so like not being certain that it's a fraud, but just being certain enough to the point of staying away? Almost like it's almost important. It's a lot easier to avoid a problem than to deal with it. So you just know this is, the situation, you're just going to stay away.
Anytime I looked extensively into a Chinese reverse merger, it appeared to me to be a fraud.
What were they doing? What made you think that?
They were making up the fact that a business existed or was at a scale that it wasn't. So the typical way of doing it was saying that there are 1,000 of these things and there's really 10 of them. There were other ones too, but that's commonly what it was. And also often the product didn't exist or didn't work or something. In a couple cases, I could tell by reading their own documents. This is a really good example. There was a company, I will not say the name of this company, but it did something which is the most common logical thing that shareholders hear and think makes sense, but actually makes completely no sense, which is that they said, well, in response to a short report, they said, well, that's using information we gave out ourselves. We obviously want to give out information that reveals that we're a fraud ourselves. Actually, almost all frauds are discovered by the company giving out information that's inconsistent itself, just like many criminals are caught by the criminal messing up. Yeah. So saying, oh, well, I certainly didn't murder the guy because I wouldn't be driving around with a busted taillight. So that's impossible. Why would I do that?
Yeah.
That's the argument that they make. And usually you can tell from their own documentation inconsistencies. There are certain ways you can see those inconsistencies. I think they were a little tougher in China than in others, but reading through them, a common one was that there was mistakes in certain things in terms of the the extent of the deception had not correctly at lower levels adjusted for certain numbers. So there was a very top level fraud without having lower levels correct all the other different numbers for that. And actually there was something, and it's hard to tell with these things because there's something we were talking about not a long time ago, but a while ago, I'm not going to say what it was, but it was government statistics on stuff. And it looked wrong to me. And the reason why it looked wrong is that it didn't look sufficiently randomized in the way that I would expect. It looked like how a human would randomize a number. And so when you ask a human, you draw a square and say, put down 9 random dots, they do this. In reality, random dots should clump here and here and here and stuff. They shouldn't actually look that random. Mm-hmm. They draw like a wiggly line when they think that you want that sort of thing. Now, that's a weird mistake, and maybe if it did happen, there wasn't it shows kind of a weak knowledge of forensic stuff about accounting or about numbers and things, statistics. But that sort of thing can happen and did happen in some cases when I was given a Chinese reverse merger to look at. Basically, the company talked about something and it didn't match up with something else. Now, the company would say, oh, we made a mistake. It's not really true that we pay X amount total tax, which is this amount per unit. We miscalculated that or whatever. So like, for instance, it would look like they were paying on 100 units taxes and they claim they have 100,000 units, mm-hmm. that kind of thing. And another case was a turn issue. They didn't, so one part of the business was correctly reporting something about it. Probably they were correctly reporting inventory, but they were incorrectly reporting sales. So it made it look like they had incredibly high sales velocity. Turnover was tremendously high. And in some weird business, you can't tell that that's true. But if it's a simple business, you can. It's much easier to detect fraud in simple businesses that are well explained than in businesses that are complex and you can't understand. For instance, I'm sure I couldn't detect if Enron was a fraud or not because I can't tell you to this day what Enron was doing. You know what I mean? Mm-hmm. Tyco's a similar one. How much of Tyco was fraudulent, how much wasn't. They kept acquiring things. So the adjustments in the acquisitions are very easy to hide and stuff. So actually, under the hood, these could all be perfectly legitimate businesses, and yet they could do tremendously manipulative things with each acquisition. And if there's a lot of acquisitions, it's hard for me to tell that under the hood is a totally legitimate business on an ongoing basis, but each acquisition they're doing is very fraudulent in what they're doing. And if people are counting the acquisitions, then it's hard to tell. So that's the sort of thing that happens. Usually it's much easier to verify a simple business that's standing still rather than acquisitions, very hard to tell. And anything that it's hard to understand what the business is in the first place. Mm-hmm. So like, can we tell what a fraud is at an investment bank? That's just so hard to do. I don't even understand many of the things that they say that they're doing and stuff and how they would hide it. On the other hand, a company that produces a product that it sells to grocery stores or a product that, sites that it operates that you can go visit or whatever, it's much easier to tell whether they are or aren't a fraud.
Mm-hmm. It's interesting because remember when I had Geoff Johnson on the podcast, who I think he's going to come back on. We're waiting to see on that. People have asked, but it's gotten pushed back a couple of times. He was talking about when he was CEO of a company and they had like a $700 million enterprise value in the oil business. He said when they changed the laws where CEOs were going to have to sign off on the financial statements, he started taking accounting classes because he's like, he pretty much was like, gosh, how does anyone know at any point, like if this is 100% correct or if how much, cash, cash is probably different because if it's in the bank account, but just like the values of everything and just the business, all the numbers and everything.
Right. Yeah. And so the way that you do it, the best that you can is you have some knowledge overall of how auditing works and stuff is really what these people need to know. They need to have some knowledge of auditing stuff. They need to put the best people on the audit committee, and they need to have some understanding of who are honest and people who are experts in that field, the same way you'd rely on like legal stuff. CEOs and stuff do not have enough accounting knowledge generally to be able to understand these things, but they should know the difference between a very scrupulous big accounting firm that's taking things seriously and one that's willing to sign off on absolutely anything that they put there. Mm-hmm. In China, things is a good example in that their companies were often warned that their Chinese subsidiary that a U.S. company had bought or something was making things up to make the numbers that they had wanted. In the first place, when they said, we want to grow by X amount, they may not have meant make up the numbers. Yeah. But they had plenty of information early on from accountants, from consultants, from whatever that they would put into these things that would tell them this is what's happening. And so you have to react seriously to that when you're told that information.
I've studied a couple frauds in the past, and I think the overwhelming theme is always that management is compensated by the stock price.
Yeah.
And then they're incredibly promotional with their press releases and stuff like that. you
Yeah.
know? And a lot of times they'll release like some sort of faulty press release and then they'll issue an at the market offering and just dilute into that,
Yeah.
I mean, there's just so many sketchy things that happen.
There are certain keywords to avoid, kind of things like buzzwords or whatever you want to call them. Main ones are like comparing yourself to very successful businesses, or even more so very successful stocks. Now, sometimes it may be totally legitimate, but other things equal, you don't want someone that is doing the, what they say in like Hollywood is like, it's speed is die hard on a bus, You don't want them to do that kind of thing, because that's how you pitch something to get people to immediately understand that your thing could be a movie that's successful. When they do that with a stock, like, okay, so Netflix has been really successful, so we're the Netflix of music. That's what you call yourself. I mean, that's what you repeat over and over again. Or we're the Netflix of books, or we're the Netflix of whatever. Or it's Google or something, or, so then you say that we're the Google of medical data and things, and say that kind of thing. It's fine if that's true and stuff, but if that's what they say, and especially if they make that comparison to several things, that is definitely concerning. If they issue themselves a lot of stock options over time without actually owning stock by buying in the market, stuff like that is
or
more
performance
likely.
targets like for their bonuses for like multiples above the current share price.
Well, yeah, and so that's a worrying. Thinking related to that is incentive stuff can also be worrying, because if their incentives at different levels would encourage fraud, then you want to be careful. This is like what we talked about with like the Wells Fargo thing and stuff. Some people might think it's a really good idea to have bonuses targeted to things like achieving certain market cap levels and stuff like that. I think that's a really dangerous thing, because you would know what levels you need to hit and at what points and stuff. And it's very easy to push off information about when we say things, when we don't say things, how we kind of paint a picture by such and such a date. So, if it was that you're compensated, if it was like that you're compensated on the 5-year average market cap, well, it shouldn't be market cap, it should be share price, but the 5-year average share price of your stock over that time, you get a percentage based on that or whatever, that would be fine. But what it usually is like, did you hit such and such a market cap or stock price or whatever for just like a matter of days or something before such and such a date?
4 days.
Yeah, and that's really, really worrying when it's something like that. Yeah.
Why 4 days?
Yeah.
Why do they do that?
Yeah. So, those sorts of things do worry me. The business being simple is the easiest. We were once talking about something and you were like, how could this be a fraud and stuff? And I was like, well, here's how you could do it that it could be a fraud. But what it basically needs in those cases is that they could suck money out of the business by dealing with someone who they probably deal with. They have a vendor or something, or a broker or something that they deal with all the time. And they could just choose someone who in theory is your brother-in-law or something, but in reality is really you behind it. And that has been done with some companies, and they could be doing that. And then it becomes a little more likely the cash they say is there isn't there. There are some things that can tip you off sometimes, but there could be explanations for why it is. I was talking about a company recently where it bothered me that they admitted that they were, so the company had X amount of millions of dollars of cash and cash equivalents, and they mentioned how much they're over the FDIC limit. So by my math, they were basically telling you that we hold all of our cash, which is an extraordinary amount of cash, in what seemed to me to be a single bank account. There could be a totally legitimate reason for that, because you could also be borrowing from that bank or something all the time. I wouldn't generally worry that you're actually going to lose the money that's in excess of FDIC limits, So maybe they have a great banking relationship and that's how they do it. They leave, $10 million at that bank all the time and stuff. It doesn't necessarily worry me that much, but that's a line that companies will say and people may have overlooked and stuff. And I would just pay attention to it, because it's more normal for a company once it gets to have that much money to either not hold it all in one bank account with one bank, or to like hold things like T-bills and stuff like that. But of course, maybe you do it because the bank's like, well, that's how you're going to get a credit line and stuff like that.
Well, how could that be a fraud? Maybe for the people that like, how could a fraud come out of that?
So one thing is that from an auditing perspective and stuff, that means that all they have to check is the balance in one bank account in one bank. So one thing about how like audits work and the check on that and stuff is that I'll just give an example. I know someone who's an auditor in another country and stuff, and they audit some major public companies in that country, and it's an Asian country. It's not China, and they don't do they don't follow the procedures which are considered normal procedures for even very closely held companies of very small size in the US. So in other words, bank balances are better verified in the US by an audit for family-run companies that just want to like borrow money once in a while and stuff. And that's the only reason why they have an audit versus publicly traded companies in that country. Because basically the only way they verify the balances in that country normally is either the company basically does it for them effectively, or they're tipped off. It's basically not a actual it's not a, surprise inspection, so to speak. So what I mean by that is that you're supposed to verify certain things by checking for the bank balance or something without, say, calling up the CFO and saying, can you get whatever? And so it may be checked at a particular branch with a particular person at that bank and stuff. It makes it so that in theory, there needs to be fewer and fewer people in on the fraud. Like literally one person at that bank could be in on the fraud, because you just need one person to produce fake documentation in that case, right? Whereas for a lot of companies and stuff, your treasury bills that you own is actually a little bit different than the bank account that you have, that you have. And so there should be fairly difficult. I mean, most people underestimate how hard it is to pull off a conspiracy. When you see most conspiracy theories and stuff, my problem with them is that no one would ever have revealed this information, is hard to believe because of how many people had to be in on it. Sure. Yeah. And so things where large numbers of people have to be in on it and why there's little benefit for them of why they would. Why does the auditor and stuff, why does a major auditor who you're a minor client for and stuff want to be in on some sort of fraud for that, That's one thing. I bought a company after the auditor dropped them and stuff. And one thing I think that surprised people about that though is that actually the fact it was a big auditor for a meaningless for them client, and that it was an industry that probably worried them a bit more, insurance, made sense to me that they would drop them. Whereas the problem with the clients, when you look, so you can look at the PCAOB thing, and when it's a one-person audit firm and they're their only public issuer or one of only a few or something, it's also very meaningful for them. It's kind of like if you're sitting on a board, if you were sat on a board and got $100,000 a year and that was your only income, they say you're an independent director, but you need to stay on that board to keep that $100,000. Whereas if you have $100 million invested in the stock and you're getting paid $100,000, all you care about is the performance of the stock. You don't care about, and you're not going to risk your reputation and everything else just for that. So in some ways, having an auditor that's a very small auditor and stuff versus a bigger company might have more incentives to stick with it and stuff. And if you look at the very big frauds that happened and how auditors were involved, they were usually for very big clients. It wasn't the case that I can't think of a lot of cases where it was like a big four auditor or something, and they had a really small client that they continue to do all this stuff they shouldn't have. It was actually some of their biggest clients that happened with.
And then is there anything in the financials that you could look for, like on the cash flow statement or the balance sheet? Maybe the net income to the cash flow statement?
Sure. So, just things to match up is what you would expect. There have been cases that I don't know the answer to why stuff doesn't match, and I can never figure those out. So the ones I would worry about is the promotional things and stuff like that. There are a couple companies I know of where I know they're misreporting stuff, but it's not a fraud. It could be a fraud of some kind, but it's not a fraud against shareholders. So for some, it might be tax related. I don't know, but they wouldn't need to report the exact same things to us that they're doing for the tax thing. So I don't understand why that is. It may be to scare shareholders away in a sense, like they want for the family to build up value more without shareholders knowing about it. So I have seen things where they actually have more earning power and more asset value than they're telling shareholders. And so I can detect that, but I can't tell what that is. So that's why I would say focus more on the promotional aspect and stuff, because those people have never issued themselves or basically haven't issued themselves stock and stuff. They just own the stock for the long term. And so what's the benefit of doing this? I don't get it. But it maybe it keeps shareholders away from realizing that they're piling up more like assets and stuff in the family's piggy bank, and not their piggy bank, but like one day they'll sell this or something. It's, as far as I can tell, totally legitimate for shareholders. So you can find it that way, but I wouldn't be as cautious about those sorts of things. It's the things that are really promotional and stuff. Usually the ones that are more hidden aren't frauds that way, except they could be taking money out of the business, which is the thing to pay attention to. And there's some dark stocks that really make you sign NDAs and stuff where I suspect that there's a relationship with a firm on the outside that they do business with. A big thing to look for is like the concentrations with others and things like receivable things that they have with them, related party transactions and stuff. But those you have to be careful with, because I've looked at related party transactions and I've realized that some people get a different conclusion than I do. Like I looked at one, there's a related party transaction. I did the math on it and I'm like, wow, they're giving them like below market rent and stuff on this. Like basically they probably owned a building or whatever.
Like the CEO did?
Yeah.
And rented
and
into
they're turning
business.
over part of the business or whatever to them at a like tremendously low rate. And other people said,
I've seen the alternative.
Right. And that they hated that there was a related party transaction, but I did the math and I'm like, they're getting this for a fraction of a square foot per month versus what I think it must be in the city and stuff. Now, I don't know. I would know exactly in Plano or whatever, but it just seemed to me remarkably low, which just seems like, I don't know if that's what I would call a best practice to be doing those things, but actually it's benefiting you as a shareholder. Whereas you should be able to detect the opposite. If there's a compensation arrangement where someone for their design expertise is being paid $300,000 a year or something, that's probably a way of just paying family members. Yeah. But if you have rent that you're like, wow, they're renting that office for a lot less than I rent my apartment for, then you should say, okay, well, where is that? Oh, it's in the middle of the downtown or whatever. That sounds like either they worked it out very fairly of what they thought it was worth, or even they bent over backwards to do a deal that's better for shareholders than for themselves, Whereas people just look down related party transactions are like, oh, there is some, Whereas like lending the company money at 9% a year, which I've seen things like that, it's like, well, can the company not access any bank money and stuff? And, so those sorts of things, especially if they could do that while you think they should be able to access bank stuff, is very, very problematic. Sure. I don't like when they own more than one business in the same industry a lot of times. I have to warn, I'm careful about that. I know of one business that people like a lot that's a microcap, but the guy actually owns a competitor that's at least as big or bigger. And I don't know, I kind of want to be in the business that like, I want to know which one he's favoring that way. It's kind of like a holding company thing. I would want to own the top part of the holding company. I wouldn't want to own something in the middle if he benefits from the top part. So my interest and his need to be aligned,
Cool. What books do we have? So a good book on frauds in financial statements, Financial Shenanigans. That's a great book. And then Quality of Earnings. That's a great book. What do you got right there?
This is just Interpretation of Financial Statements by Ben Graham. But if people haven't read it, it's a good one. It's very short. And because you need to know some accounting to do this kind of stuff, but it's as basic as this kind of accounting. And then you'll be able to see the things I was talking about. Cool.
Well, I want to thank everybody so much for tuning in with Mr. Geoff Gannon and myself. This is the Focus Compounding Podcast. If you want to support us, a rating and review goes a very long way, but also subscribing on YouTube and subscribing on the podcast side of things.
And subscribing on the podcast side will help you even more now because we're going to change some things and make sure you get all the episodes and stuff. Definitely be a subscriber. That's the easiest way to make sure.
That's right. I want to thank everybody so much for tuning in. We will see you in the next podcast. Take care.